So we're looking at here today. I was waiting to see if anyone was going to join us on this live stream, but if not, I'm going to keep on. I'm going to keep going. And so what I'm looking at here is NVIDIA, and so we're going to take a peek at NVIDIA here. And the point of tonight's discussion or live look is to try to figure out where NVIDIA is, where the price is moving. But we're going to look at particularly a huge opportunity to grab NVIDIA for as little as $35 a share. That could be anywhere in the range from $35 to $65, but we're going to dive into here, look at some charts, and we're going to go through this exercise of marking up this chart to see how we look at structure, at market structure, and determine, if and when is a good opportunity for us to get into the markets. So let's dive into the in the chart. I'm going to start. We generally here at Akeelah, we generally start looking at an asset on the 4-hour time frame. And then pair up to the weekly. So the weekly and the 4-hour time frame kind of correlate together. But for these purposes here, I'm going to start out on this weekly look because I want to make a couple of points about how did we get down to this place. So this here was back in May. This was the week of May 14th. NVIDIA had its earnings that week. Let's see. Was that the peak week or not? No, it looks like earnings was the week after that. So the week was of May 20th is when NVIDIA had its earnings. And so one thing that we had noticed in here was that there was a significant structural break. So here on the weekly time frame, this is the largest scale that we typically look at. The overall structure here was still showing bullish. You'll see where NVIDIA has kind of come from. We had a long consolidation period back here from August of 25 pretty much until March of 26. But when this thing started pumping, this was the big move. So we peaked from 164, 165-ish area back in the end of March, and it went on just a complete tear all the way up to this high of around 236. So this was the big move that we like to look at. And one thing that we focus on is markets like this. Nothing continues to go up forever. Market makers are generally driving this market. So large institutions, big hedge funds, people that have a lot of money, billions and billions of dollars that are moving the market. These are the ones that are making these substantial moves. So when we see something like this, what draws our attention is we go to, and actually this is the daily look that I'm on right now. So one thing that is important is we look for support. We look for where's the last demand zone. Now here we have a different way of defining demand zones than is traditionally done in the markets. I know people have their different strategies and ways to look at what's a supply zone, what's a demand zone, but we have a very creative way that we do it here that is patterned after large institutions, large market makers. And so let's dive into this and take a look at. So one key thing here that I'm going to point out is, again, this is the daily chart. And so the support area that we see right now on the daily, I'm going to get a couple of tools over here to draw with. The areas that we see that are going to be critical in terms of this support on the daily time frame is the first demand zone. That's what I want to highlight. So let's go here, and we would identify daily demand zone as this area right in here. Okay. I'm not going to mark the current price, but this will be daily demand zone. I typically use blue for my demand zone areas. Okay. So this is the area at which NVIDIA needed to hold this support. And so even back here, when we were on the way making to this new high, this was pretty much of a stretch. So this support area here was right here between 195 and 200. This is the area that the farther that the price got away from this, the more likely it needed to pull back here, because markets that are moving, one process that we follow is that a market that is bullish will continue to be bullish, will continue to increase and make demand zones until there is a break of structure. So when you see the market extend up like this, it has to come back to this demand zone area in order to keep going. We have to see this is healthy for the market so that we don't get this Jenga effect where something just keeps going, building higher and higher and higher, and eventually it gets so wobbly that, the whole thing topples. So for a market to be healthy, we have to have this kind of demand zone. Prior to us, I'll leave that alone. We'll come back to that later. But so this was a demand zone. So even here, when the market was at these all-time highs, we were at 236 at that point. The demand zone area is down here near 200. So $36 extended beyond that, the market was calling for a healthy pullback. So how do we know that pullback was coming? That's one of the key things here. You may see that this is a demand zone, but how and when do we know to expect it to pull back from there? Well, that's where we dive into some of our more detailed market structure. And so what I'm going to look at here, we're going to go down to the 4-hour time frame. Go down to the 4-hour. And at this point here, what I want to point out, the way we read the markets and we learn to identify the structure, when we were at this high point here, the last 4-hour demand zone, we're on the 4-hour time frame now, the 4-hour demand zone was right in here. And so this area. So I would identify that as a demand zone. And so with this being a demand zone, then the market, in order to continue moving up, NVIDIA would have had to come and hold this support area. The bottom of this area was around 224. So if we're going to continue bullish, we need to hold that 224 price area. If we see a close below this, we would call that a break of structure. So a break of structure in our book is a market close on the relevant time frame, a market close below the prior demand zone. And so let me extend this out a little bit and you can see what happened here. So here, now these again, a 4-hour candle. So this 4-hour candle dropped down. It did penetrate that zone, but did not close above. So we're still safe here. The next 4-hour candle did the same thing. We had a full candle body come all the way down to 225, but it rejected back up. And this was the next day. So that's not quite earnings day. Okay, so this is still prior to earnings. So here, the market gapped back up. So it gapped up back above here, but you see immediately this closed below. So this was what we would identify as a break of structure. So when we got this close here, that's a 4-hour break of structure down. Now, the way we learn to read the markets and the way we follow market makers or follow this strategy is that once we see a break of structure, then let me get my other little crosshair over here. Okay, so once we see a break of structure, then the most likely thing that we teach, and this is how the markets move. So if you're not learning this, if you're not learning how overall markets move, there's a rhythm, there's a process to this. Institutions that are moving billions, hundreds of billions of dollars, they don't do things haphazardly. There's algorithms that are running this. Algorithms are controlling the vast majority of trading that's done now. And so these systems are designed to operate in a certain way. And so that's what we teach, how to read these markets. So once we see a break of structure, this is part of our process of teaching. One of the things that we expect to see almost, I'd say 80% of the time, we're going to see a return back to what we call the source of that. And so the source of that is what move in the market led us to cause this break of structure. So the market's been going up, pull back a little bit, up a little, pull back, up. As long as you're holding demand zones, that's fine. You can keep doing that. But when we have a structural break, we want to identify, well, where did that break come from? That move that caused this break, where did that originate? And that's up in this area. And there's more specifics. We get into a lot more details in longer, more structured classes. So this is what we would call a source here. And I like to put my sources in yellow. And so this yellow area here is, oops, let me clean this. I don't want to feel that's what I'm trying to do. So this yellow area here is what we would call our break of structure source. So the break of structure source, once we see a break of structure, if this move downward is going to be confirmed, what's most likely that we would see would be something like this. We would see the market pull back up to this area and then reject. And so if and when we see that, now let's go forward to see, did we see that here on NVIDIA? It did not pull back up to this area. So the second option that we teach and we follow is you either will immediately or pretty shortly afterwards see a pullback to the source area. So we did not see that, or you would see a retest. So option two is you would see a retest of the structurally broken area. So this was an H4 demand zone. I'm just going to put that in here for this, because all of this leads us up to how we're going to read the market and identify how we can get into this asset for this as low as $35. So I'm just laying the foundation for this because this method just replays over and over and over. This is not just something that happens. It's not an anomaly. This is how markets move. So when we see this, especially on a large scale, when we see it on a higher time frame, it's even more valid. So we didn't do option one. Option two was to come and retest this area. So with a retest, we follow and teach that you need to see a healthy retest of this zone. So we broke below it. We want to see the market try to penetrate and pull back up into that zone, but get rejected. Once we see that rejection, which in my case, that would have come either after this candle, but definitely after this one. So probably after here, we would have said, this is a pretty strong confirmation right here. I'm going to put that one in red. That's a pretty strong confirmation that we had a rejection. And I will call that a BRR, which is just simply break, retest, and rejection. So once we see that break, retest, and rejection, that's a clear sign that this move is validated. This market was moving up, up, up. But once we had a break of structure, the market pushed back up and retested that break of structure and now gave us confirmation that it's going down. So once we see that happen, then that's our cue to say, hey, this market is getting ready to fall. And this is when NVIDIA is at the 220, 225 area. You can go in and check some of our posts and things that we have in TradingView and in some other in our trading channels. And you can see where we were noting that this structural break here was going to lead to a fall in NVIDIA. So now where is it going to go? How do we know once we see that kind of structural break, where is the market going to go? So what we focus on and teach is that once we see a break like this, the market is most likely to go to the source of that move. And so in this case, just like it came back to the source of this break, once the break is confirmed, it's most likely to go to the source of the initial move that that started. So this big bullish move, where did this big bullish move originate? Well, that bullish move originated down here, back in this area. And so this would have been, since I was on the daily chart, this corresponds to my daily demand zone. I drew this. Let me go back to the daily. So on the daily chart, this was my daily demand zone area. I didn't label that in here. It should be daily demand zone. So that's my daily demand zone area. That is going to be my target if I see a structural breakup here. I can go down to the 4-hour, which we did to get a preview of that. When we saw that 4-hour break, this was pretty strong confirmation. Again, when NVIDIA was sitting at 220 to 225, this was very strong confirmation that NVIDIA is going to fall at least down to the $200 range. Okay. And so this is where we see the market played around with this a little bit. And I want you to note something right here, because follow this zone in here. See, we eventually tried one more attempt to push back up. But in my mind, in our minds, this move was already confirmed. It's already confirmed that this is a breakdown and that the market is going to fall. So when you see things like this these days here, the first part of June, into June 1st and June 2nd, when the market pushed back up, this is all one big trap. This is one big stop hunt trap to try to entice retail buyers to get back into NVIDIA, because ultimately we're going back down to $200 or slightly below. Okay, so you see that kind of fake out. The way to not get caught up into those is to go back and look to see, did you have confirmation that the fall was going to happen. If it was, then you don't follow this whatsoever. If anything, you're looking for sales. You should be looking to see it could have possibly pushed up as high as this and then rejected. That's what you want to look for. Okay. So now let's go to fast forward to where we are now. So as of right now, we came down to this daily demand zone area. We actually came below this. I'm on the 4 hour. Let me go back to the daily. And so now we need to see how we're behaving on the daily demand zone, on the daily time frame relative to this demand zone. So this would have been the full short move. Short NVIDIA up here in the 225, 230 area, bring it down to sub 200 or right at 200. Okay, so now that we're here, we need to see, is this zone here going to hold? This does not mean that the fall is over, folks. It means that now, once we get here, we need to assess to see if this daily demand zone is actually going to be enough support to hold the market up. So let's go back to the daily. And what you see already here is this is another structural break. So here we now have a daily break of structure. So let me label that. This is now a daily BOS down. So we have a daily break of structure. So just like we saw on the 4 hour before, we saw the 4 hour close below, it retested and rejected. It tried one more time to push back up. It did not come back to that source. We would expect to see the same thing on this daily. Now that we have a daily break of structure, that this market is going down. What is going to sustain this or keep it from going down further is going to be, we need to break back above this this demand zone. We need to see a daily close back above 202. If we close again daily back above 202, then that negates this break of structure. But until we get that close back above that, this break of structure here is still in place, and we could likely get just a retest of this. We could just pull back to here, not break above the zone, and continue falling. So if we do continue falling, now that we have a daily break of structure, we have to look on the daily and see where is the daily source of this. So hopefully you folks are seeing how this plays over and over. Let me see if there's, I didn't have anybody in the chat there, but it's all good. So I want you to see how this plays over again, just like we saw on the 4 hours. So now if we have the daily here, if this is going to do one of two things. Either we're going to have a pullback up to the daily source, and now this was our H4 source. I'm going to expand this because now we got bigger daily candles here. The daily source is going to be like up in this area. So we would, with this daily break of structure, if this move is going to continue down, then we would expect to see a pull back up to this, which would now be the daily break of structure source. I'm going to label that daily BOS, and I will call it a BOS supply source. So this is where the selling initiated that started this move that caused this break of structure. So we're either going to see it push back up like this. I'm going to draw that. So push back up here to this area and then reject down. So look for that kind of move. Or we may again just see the retest of this area. So these are the bearish scenarios, which is going to present us the best entry opportunities. So the other bearish scenario is that we don't break above this, that it pushes up to this area, but fails to close above 202. If it fails to close above this, comes down, we may get another little pullback to retest the bottom of this, but then it's going to continue to fall. So what we want to eye now is, where is it going to potentially fall? This is the whole point of our, how do you get this for $35 or somewhere in that range, from 35 to 65. Where is it going to likely fall? Now we come back here to the daily. So the daily source, where did this big daily move start from that pushed all the way up and eventually got broken? It's down here. So my daily source area is down in this area. So this is what I'm calling my daily demand source. Okay, so I'm going to call this daily demand source. Let me, yeah, I want to leave that as red. That's fine. So this is the daily demand source. So this area is like 163 to 170, 169 and some change, somewhere in this area. So if I'm going to look at if NVIDIA is going to continue to be the powerhouse that it is in the AI market, in the technological market, then this area down here should be a reasonable floor for this. We need to hold this area, this daily demand source area. We need to hold this area if NVIDIA is going to have any kind of, positive bullish move in the near future. Near could be 6 months to a year. Okay, so we need to hold this area. So how are we going to play this? Can I get it for $35 kind of thing? Well, this is what we're going to talk about CFDs. So I'm going to switch gears a little bit and talk about how we trade in the markets with CFDs. So CFDs is just contract for a difference. So contract for a difference means that I don't actually have to acquire the full stock. I can acquire the position in the stock, either long position or short position, depending on whether I want to buy it, I'm expecting it to go up, or whether I'm expecting it to go down. So I can do a long position or short position. So long position is what the opportunity is. This is what I'm looking for. So I want to be able to position myself such that I identify the bottom, or at least potential bottom, right? We're not saying this is the absolute bottom, but we're saying this is a strong enough bottom that if NVIDIA goes below this 163 area, there has to be something major, catastrophic that's either going on with the overall stock market, or going on with the overall global economy, or something catastrophic going on with all of AI and advanced technology computer chips, right? So, and if that's the case, then everything's down, and the market's just tanking. There's not much you can do about that. So, but let's identify this bottom area. So this is around 163. I'm going to pick a stop loss area that's going to be just significantly below this. So for round number purposes, I'm just going to pick right here 160 because I just want to easily do the math here. Okay, so we're going to say our reasonable stop loss area for NVIDIA is going to be $160. Now you may, in reality, have to give yourself, a couple of more points, $2 or $3, $5 or something, maybe 155. But I'm going to do it at 160 just for ease of explaining this strategy. Okay, so as long as NVIDIA holds above $160, I expect it to hold that, and then eventually over time, this market will climb back up, and it'll get back to the $230, $240, $300, $500, and beyond, whatever, right? So this strategy is designed to say, how can I hold this long term without being taken out of the market? So my floor is 160. Then I want to look at my entry, and my entry, I think when it closed, well, right now it's sitting right at $200. It closed at 199. So at the time we were discussing this earlier, it was like at 195. And so for these purposes, I'm just going to use, I'm just going to use what it is right now, $200. Okay. So here, my potential entry as of right now, even if I entered it right now, and again, we did this at 195 is when we first started posting this. But let's say our entry is at $200. Okay, I'm put blue there. That's my entry. So what I need to look at is to say, what is this gap here? If I enter this at $200 and I have a potential floor, at least a reasonable floor of 160, that is a $40 range, right? So I'm gonna look here and say, what's the difference between here and there? That's the $40. And again, it was 35 at the time we originally started talking about that, right? So I'm just gonna say this range is 35 to $40. Okay, so this is my risk range. So this is my potential risk range to say, look, if I am wrong and NVIDIA is really not what it's all cracked up to be, it's not going anywhere, it's not gonna be anything substantial, AI is a bunch of junk and it's all gonna fall apart, right? My reasonable risk range for that happening is $35 to $40. All right. So that means that I do not have to go and acquire NVIDIA at $200 a share. So we're going to look at some mathematics here. If I bought a share, if I wanted to buy a share of NVIDIA right now, it would cost me $200. Okay. So if I bought it at $200, and let's say I held it for this time right here, and it did come all the way down to 160, then I bought it at 200, it dropped down to 160, so I've lost $40. I may still hold the share, but I have my portfolio has depreciated by $40 in value. Okay. So let me go here and I'm gonna do a couple of ones like this. So if I have one share of NVIDIA, that would cost me $200, and that is a $40 risk. Okay. Now, if I had 10 shares, if I wanted to buy 10 shares, I would need $200 price times 10 shares. I would need $2,000, right? $2,000. And then now that would be a $400 risk. Let me bring this in a little bit so we can see everything. Okay. So hopefully you're following me here. That would be a $400 risk. So I would have to put $2,000 up front, bring that $2,000 out of my checking account or something, put it in Robinhood or whoever, and go buy 10 shares of NVIDIA, right? Next, let's look at 100 shares. So if I did 100 shares, that would be $20,000 that I would need, and I would have about 4,000 of that at risk. Okay, so 100 shares. If I wanted 100 shares of a stock, that's $200. That would cost me $20,000. So I would need $20,000 in capital to open that position. And again, my risk would be, if it came down here, I'm potentially risking $4,000. Last one we're going to do is 1,000 shares. Okay, 1,000 shares would equal, I would need $200,000, and I would have roughly $40,000 of a risk there. Okay, so this is at this range that we're talking about here. Now there is a lower area that NVIDIA could potentially fall to. So if we do not hold this area, the longer term, total market collapse area is going to be down here somewhere. And we've got another full video that we posted where that range is. But for these purposes here, we're not considering that area. But it would be down here around the 130 or so. So 130 would be the long move down here. That would, instead of coming to 160, that would be $65 to $70 risk. But for these purposes, I'm going to stick with this example here because I'm trying to teach the concept, to show you the concept here without getting into the specific details. But this is very reasonable range. And look how much of a substantial savings already just by being able to read the markets, to understand how the markets are moving. We prevented ourselves from being one of the people that bought NVIDIA at 220. Somebody bought this at 220 thinking, hey, this thing is eventually going to $300, $400, $500, right? You don't want to be that person. You're getting it down in this range at 195 and maybe even lower, right? So this is what my overall risk on this would be, about a $40,000 risk at this point. If I had 1,000 shares, $200,000 in capital that I would need. Now, how do we play that exact same thing with CFD trading? With CFD trading, we can control the position and we can use leverage. And so we have two opportunities here, two golden opportunities. One is CFD. So that's contract for difference. Okay, so that says that I don't have to hold the entire, let's use 100 shares for this example here that I'm talking about now. I don't have to acquire the entire 100 shares. I can say, look, I want to have a portion of this. I want to, instead of having to have $20,000 to buy 200 shares, I want to just have enough capital to cover my risk. My risk is a $4,000 risk. So if I want a $4,000 risk, I only need to have $4,000, right? I don't need to have $20,000 because I'm not risking NVIDIA going to zero. I'm just risking it going to stand above $160. So contract for a difference gives us that opportunity. It says, what is the difference in price that you're willing to risk? I'm willing to risk if I come in this thing at $200 that it's going to stay above 160. How much is that? That's $40 times 100 shares. That's $4,000. Okay. So contract for a difference would say I would need $4,000 in capital. All right. And now there's a little other things to consider here, the amount of margin that you have to hold that position. So that's going to be plus or minus a little bit. So for these purposes right here, I'm just going to say that's going to round up to around $6,000 total, but it's still not going to be 20. All right. So contract for a difference gives me that opportunity. Next thing is the next superpower that we want to take advantage of is called leverage. And so leverage is basically, in a nutshell, is use less capital to control the same position. And this is how many people get confused on what leverage is. In most people's minds, leverage is, oh, you're compounding the amount of money that you're putting into the market and you're greatly increasing your risk. Well, that's if you don't know how to use leverage, if you use leverage the wrong way. Most people, leverage is, hey, you're going to go and over maximize a position and a small market move is going to take you out. Well, you're not using leverage properly. So in our case, we're going to use this leverage to say, now back to this $20,000, instead of me having to have $20,000 to open this position, my contract for a difference is only requiring me to have between $4,000 and $6,000 worth of capital. And now for leverage, in our leverage example, I'm going to say, well, what if we're using, I'm just going to say 2x leverage, right? What if we're going to use 2x, twice the amount of leverage that's necessary for this? So we're already down to needing, let's say, a maximum of $6,000. Well, if I'm going to capitalize my broker, and these are contract for a difference brokers, this is in the commodities and futures exchange that's doing this, that's offering this kind of leverage, then if I've got 2x leverage, instead of me needing $6,000, it's 2x, so I cut that in half. So I really only need a max of like $3,000, right? So that says that I would need a maximum of $3,000 in capital, at least to open that position. That's where the leverage comes in place. I need that amount to open that position, but nonetheless, I still have a $4,000 risk, right? And so this is where I would come in and say, to make sure that I, don't get completely liquidated, $3,000 of leverage is required to hold open that position. And if I get in a negative up to $4,000, I'm going to be taken out of that position, right? So that's where I keep this. That's why I added a couple of grand to the 4,000 that's actually needed, because some percentage of this leverage, I don't want this leverage here to drop below. I'm going to say it needs to stay above. In the brokers that we deal with, we have very strong CFD brokers offering us substantial leverage. I mean, grossly beyond this amount that I'm pointing out in here, but you got to know how to use it. So that leverage needs to stay above, I'm going to say above 50%, right? 50 to 60%. And that's why I'm saying, look, I don't want to overuse this. So here, 50% of that $3,000 that's required, that's about $1,500. If I add that $1,500 to the $4,000 range risk that I'm having, that's about $5,500. That's back again why I'm saying $6,000. So folks, in a nutshell, for $6,000 in this example, $6,000 in capital, I could control 100 shares of NVIDIA. which in the traditional, go to TD Ameritrade, go to, you know, whoever, Charles Schwab, whoever your broker is, go to Robinhood, go to any of these places that you would potentially do this. To control 100 shares, you're going to need $20,000 in capital. But we're showing you how, in this case, you could take $6,000 in capital, understand how the market is moving, get a CFD position at a good opportunity like this. And again, I'm not saying it's not going to keep falling, right? I'm saying I'm reading this. I'm reading this to tell me, to give me some good signals to see if the market's going to continue to fall. If I get a strong read on the market and I see that it's going to continue to fall, then I'm not going to hold this position at $200. If I see that it's potentially going to come down to 160, with the type of trading that we do, you can get in and out of these trades anytime the market is open. So I don't have to hold it the whole time, because the short term is, once again, if the market does not hold this area, we're likely coming down to this 160 area. Minimum amount, there's some gaps over here that need to be filled here around 180. And in one of our other posts, I've already, highlighted the fact that if this area doesn't hold, it's probably more likely coming to 180. So you can either wait and see if it comes down to this area, if we get confirmation there, then you enter your position. And if that is the case, if you're coming in at 180 and your floor is 160, now that's only $20 a share. So now you can increase the amount of shares that you're holding. You don't need, for 100 shares, you'd only need $2,000. So you could do 200 shares for the same $4,000. You see? And so there's some other things to consider in here, but this is the main point. So this is how anyone who is able to either read the markets or at least understand how the market's moving here, you can see this is a huge opportunity to get into NVIDIA and be able to hold a stock like this long term, right? Long term. So I'm not trying to teach you how to day trade it. I'm not saying you're getting in today and you're out tomorrow, day swinging, overnight holding. And when we enter this kind of position, you're going to have to be resilient here, knowing that this is the floor area that we're targeting. So if you're able to do that, that's how you're going to be able to control NVIDIA right now for as low as $35 a share. You multiply that by however many shares that you feel that you want to control. The risk is in proportion to the number of shares. So before we close this up, I'm going to end this with, I want to look at the upside of this. So why are we even doing this, right? So if we enter this position here, I'm going to keep it as it is at $200. If we enter this position of NVIDIA at $200, and where you're going to use the 100 shares example for these purposes here, right? And you're controlling 100 shares, then what this looks like is you control 100 shares of NVIDIA at $200 a share. Okay? So because we're talking about contract for a difference, right? So the contract for a difference, what this means is you profit or lose based on the difference in the share price relative to the $200 that you got in at. So let's assume if we're in it at $200, we already did the downside, right? We come in at 200. If this thing drops down to 160, I have lost $4,000. I'm negative $4,000. But the point I want to make here too is that that's exactly the same as if I forked out $20,000 to buy 100 shares and it dropped to 160. I'm still in the hole $4,000. So the amount that you go in the negative, it doesn't change. It's not elevated because you're trading contract for a difference or you're using leverage. You just got to be smart and not over leverage it, right? So if we do the same thing, my risk was $4,000 if it dropped to here. At that point, I could cut my losses and get out, or I could say, well, let me hold a little more and see. But you need to be able to read the markets to see what's going on. So let's look at the upside. Now, on the plus side, let's say if NVIDIA gets back, if and when it gets back to this all-time high area up here, 238, let's just say 240. Okay. So if and when we get back up to this area, I'm just going to draw it right at 240. If and when we get up to 240, that is a $40 a share profit, right? Which for us, that was, we had 100 shares. So that's a $4,000 profit. Okay. So hopefully this is making sense because I entered it at $200 a share. I had 100 shares. When it got up to 240, I now have the same 100 shares, but they're now $240. So I made $40 a share. That's $4,000 profit. So that is the same, again, I know I'm being redundant here, but that's the exact same thing as if I had forked out $20,000 to do that. But let's look at the percentages. This is how profits are made in this market, and this is how smart money moves. So instead of risking or leveraging, having to commit $20,000 in capital to make a $4,000 profit, and $4,000 profit is still a very good profit, right? But $4,000 compared to $20,000 is 20%. That's a 20% profit. Very substantial gain. Praise God for it, right? Good gain. But let's say if our commitment here was only $6,000. If it's $6,000, it was really $4,000 risk, right? We would have had, because of the leverage and things that I mentioned earlier, you need to keep $6,000 in here. Well, now you have a $4,000 profit over a $6,000 capital. You're talking about 67% increase. So do you want a 20% return on your money, or do you want a 67% return on your money? Same move, same amount of money, $4,000 made or $4,000 lost. It's the same, but why are you forking out $20,000 to make $4,000 when you could be forking out $6,000? That's my point. All right. So let's increase this up a little bit. I'm just do maybe one other milestone. Let's say if and when NVIDIA hits $300. Okay, we get up here and hit $300 a share. What's going on here? Okay, if we hit $300 a share, then I came in at 200. At $300 a share, I now have $100 a share profit, which times my $100 shares, that is a $10,000 profit. Now, still compared to my risk that I had was the $6,000 that I went into this, right? So you can see how much of an advantage it is. I'll leave it at that point. How much of an advantage it is to learn how to trade this way, to learn how to use leverage markets the right way, to learn, more importantly, how to read these markets, because none of this makes any sense. None of this matters if you buy at the wrong place. If I had bought NVIDIA up here at 230 and now it's all the way down to $200, I've already risked $30 a share. So I'm already, with my 100 shares, I would already be $3,000 in the hole. So we got to be smart in reading how we get into the market. So that's why we want to encourage you to learn, follow our channel, the way we're endeavoring to teach you how to read the markets, how to identify market structure, how to know when a break of structure, a true break of structure occurs, and how to know when to get out of that trade, right? So that's something I hope was helpful here. If you are interested in learning how to trade, how to follow things this way, we have a free trading academy that's coming up on July 7th. That'll be Tuesday night, July 7th. It'll be at 7 p.m. Eastern time. You can go to our website, which is, I don't know if I can even show that on here. Let me see, what am I sharing? But either way, our website is Trading Academy. So you can join us on tradingacademy.akeelah.io. And that, I think I'm sharing my whole screen here. So let's just go to, so you can come to Akeelah's Trading Academy. You can learn some things on here. There's 6 days left on here. It's completely free class. No charge for it. You do have to register, so we make sure you send you the right links. But you can come in here and stop guessing, learn how to read market structure. You can take a look at some examples that we're going to have in here. There's some information on here. There's past examples from previous academies. You can watch some videos of prior things that we've done. You can see some lessons from previous students, some actual trades that we've taken. When we looked at stocks in the past, looked at crypto in the past, you can see some before and afters, some student testimonials and things in here. So I encourage you to take a look at that if you want to learn how to read the markets this way, and then you'll be in a great position to take advantage of these kinds of trades and see how you can get stocks as lucrative as NVIDIA, that has as much upside opportunity as NVIDIA for a very small fraction of the cost. Okay, so I hope this helped. Hope you guys learned some things. Drop us any comments or questions that you have, and we'll look to see you next time. Thanks.